Chapter 4. Common Stock Purchases. 9 Case Studies. Over the years, Buffett's common stock purchases have become a part of Berkshire's folklore. Behind each investment is a unique story. The purchase of the Washington Post Company in 1973 was far different from the 1980 purchase of Geico. Certainly Buffett's $500 million investment in Capital Cities, which in turn helped Tom Murphy buy the American Broadcasting Company, was unlike his billion-dollar investment in the Coca-Cola Company. And every one of these stock purchases differed from the investments he made years later in Wells Fargo, General Dynamics, American Express, IBM, and Heinz. But for those of us hoping to understand fully Buffett's thinking, all these common stock purchases share one very important trait. They allow us to observe his business, management, financial, and market tenets in action. With the exception of Cap Cities, all of these companies have remained in the Berkshire fold and continue to prosper. Only the Washington Post Company and General Dynamics do not make the list as Berkshire's top common stock holdings. In this chapter we examine each purchase in its historical context. This allows us to better analyze Buffett's thinking at the time of the investment as it relates to the company, the industry, and the stock market. The Washington Post Company. In 1931, the Washington Post was one of 5 dailies competing for readers in the nation's capital. 2 years later, the Post, unable to pay for its newsprint, was placed in receivership. That summer, the company was sold at auction to satisfy creditors. Eugene Meyer, a millionaire financier, bought the Washington Post for $825,000. For the next 2 decades, he supported the paper until it turned a profit. Management of the paper passed to Philip Graham, a brilliant Harvard-educated lawyer, who had married Meyer's daughter Catherine. In 1954, Philip Graham convinced Eugene Meyer to purchase a rival newspaper, the Times-Herald. Later, Graham purchased Newsweek magazine and 2 television stations before his tragic suicide in 1963. It is Phil Graham who is credited with transforming the Washington Post from a single newspaper into a media and communications company. After Graham's death, control of the Washington Post passed to Catherine Graham. Although she had no experience in managing a major corporation, she quickly distinguished herself by confronting difficult business issues. Much of Catherine Graham's success can be attributed to her genuine affection for the Post. She had observed how her father and husband had struggled to keep the company viable, and she realized that to be successful, the company would need a decision maker, not a caretaker. "I quickly learned that things don't stand still," she said. "You have to make decisions." And she made 2 doozies, decisions that had a pronounced impact on the newspaper, hiring Ben Bradlee as managing editor and then inviting Warren Buffett to become a director of the company. Bradlee encouraged Catherine Graham to publish the Pentagon Papers and to pursue the Watergate investigation, which earned the Washington Post a reputation for prize-winning journalism. For his part, Buffett taught Catherine Graham how to run a successful business. Buffett had first met Catherine Graham in 1971. At the time, he owned stock in The New Yorker. Hearing that the magazine might be for sale, he asked Catherine Graham whether the Washington Post common stock purchases would be interested in purchasing it. Although the sale never materialized, Buffett came away very much impressed with the publisher of the Post. About that time, the Washington Post's financial structure was headed for profound changes. Under the terms of a trust established by Eugene and Agnes Meyer, Catherine and Philip Graham own all of the Post's voting stock. After Phil Graham's death, Catherine Graham inherited control of the company. Over the years, Eugene Meyer had gifted thousands of shares of private Post stock to several hundred employees in gratitude for their loyalty and service. He also funded the company's profit-sharing plan with private stock. As the company prospered, the value of the Washington Post skyrocketed from $50 per share in the 1950s to $1,154 in 1971. The profit-sharing plan and the personal holdings of employees required the company to maintain a market for the stock, an arrangement that proved to be an unproductive use of the company's cash. In addition, the Graham and Meyer family was facing stiff inheritance taxes. In 1971, Katharine Graham decided to take the Washington Post public, thus erasing the burden of maintaining a market in its own stock, and enabling the family heirs to more profitably plan for their estates. The Washington Post Company was divided into two classes of stock. Class A common stock elected a majority of the board of directors, and Class B elected a minority. Katharine Graham held 50% of the Class A stock, thus effectively controlling the company. In June 1971, the Washington Post Company issued 1,354,000 shares of Class B stock. Remarkably, 2 days later, despite government threats, Katharine Graham gave Ben Bradley permission to publish the Pentagon Papers. In 1972, the price of both Class A and B shares climbed steadily, from $24.75 in January to $38 in December. But the mood on Wall Street was turning gloomy. In early 1973, the Dow Jones Industrial Average began to slide. By spring, it was down more than 100 points to 921. The Washington Post Company share price was slipping as well. By May it was down to $23. Wall Street brokers were buzzing about IBM. The stock had declined more than 69 points, breaking through its 200-day average. They warned that the technical breakdown was a bad omen for the rest of the market. That same month, gold broke through $100 per ounce. The Federal Reserve boosted the discount rate to 6%, and the Dow fell 18 points, its biggest loss in 3 years. By June, the discount rate was raised again, and the Dow headed down even further, passing through the 900 level. And all the while, Buffett was quietly buying shares in the Washington Post. By June, he had purchased 467,150 shares at an average price of $22.75, a purchase worth $10,628,000. At first, Katharine Graham was unnerved. The idea of a non-family member owning so much Post stock, even though it was non-controlling, was unsettling. Buffett assured Mrs. Graham that Berkshire's purchase was for investment purposes only. To reassure her, he suggested that Don Graham, Katharine's son, be given a proxy to vote Berkshire's shares. That clinched it. Katharine Graham responded by inviting Buffett to join the board of directors in 1974, and soon made him chairman of the Finance Committee. Buffett's role at the Washington Post is widely known. He helped Katharine Graham persevere during the pressman strikes of the 1970s, and he also tutored Don Graham in business, helping him understand the role of management and its responsibility to its owners. Don, in turn, was an eager student who listened to everything Buffett said. Writing years later, Don Graham promised to continue to manage the company for the benefit of shareholders, especially long-term shareholders whose perspective extends well beyond quarterly or even yearly results. We will not measure our success by the size of our revenues or the number of companies we control. Graham vowed always to manage costs rigorously and to be disciplined about the uses we make of our cash. Tenet, simple and understandable. Buffett's grandfather once owned and edited the Cumming County Democrat, a weekly newspaper in West Point, Nebraska. His grandmother helped out at the paper and also set the type at the family's printing shop. His father, while attending the University of Nebraska, edited the Daily Nebraskacan. Buffett himself was once the circulation manager for the Lincoln Journal. It has often been said that if Buffett had not embarked on a business investing career, he most surely would have pursued journalism. In 1969, Buffett bought his first major newspaper, the Omaha Sun, along with a group of weekly papers. Although he respected high-quality journalism, Buffett thought of newspapers first and always as businesses. He expected profits, not influence, to be the rewards for a paper's owners. Owning the Omaha Sun taught him the business dynamics of a newspaper. He had 4 years of hands-on experience owning a newspaper before he bought his first share of the Washington Post Company. Tenet, consistent operating history. Buffett tells Berkshire's shareholders that his first financial connection with the Washington Post Company was at age 13. He delivered both the Washington Post and the Times-Herald on his paper route while his father served in Congress. Buffett likes to remind others that with his dual delivery route, he merged the two papers long before Phil Graham bought the Times-Herald. Obviously, Buffett was aware of the newspaper's rich history, and he considered Newsweek magazine a predictable business. The Washington Post company had for years been reporting the stellar performance of its broadcast division, and Buffett quickly learned the value of the company's television stations. Buffett's personal experience with the company and its own successful history led him to believe that the company was a consistent and dependable business. Performer. Tenet, favorable long-term prospects. The economics of a dominant newspaper, Buffett wrote in 1984, are excellent, among the very best in the world. Take note that Buffett said this almost 30 years ago, a full decade before the Internet's potential was first being realized. In the early 1980s, there were 1,700 newspapers in the United States and approximately 1,600 operated without any direct competition. The owners of newspapers, Buffett noted, like to believe that the exceptional profits they earn each year are a result of their paper's journalistic quality. The truth is that even a third-rate newspaper can generate adequate profits if it is the only paper in town. Now it's true that a high-quality paper will achieve a higher penetration rate, but even a mediocre paper, he explains, is essential to a community for its bulletin board appeal. Every business in town, every home seller, and every individual who wants to get a message out to a community needs the circulation of a newspaper to do so. Like Canadian media entrepreneur Lord Thomson, Buffett believed that owning a newspaper was like receiving a royalty on every business in town that wanted to advertise. In addition to their franchise quality, newspapers possess valuable economic goodwill. As Buffett points out, newspapers have low capital needs, so they can easily translate sales into profits. Even when a newspaper installs expensive computer-assisted printing presses and electronic newsroom systems, they are quickly paid for by lower fixed-wage costs. During the 1970s and 1980s, newspapers were also able to increase prices relatively easily, thereby generating above-average returns on invested capital and reducing the harmful effects of inflation. Tenet, determine the value. In 1973, the total market value for the Washington Post company was $80 million. Yet Buffett claims that most security analysts, media brokers, and media executives would have estimated WPC's intrinsic value at $400 to $500 million. For how did Buffett arrive at that estimate? Let us walk through the numbers, using Buffett's reasoning. We'll start by calculating owner earnings for the year. Net income, $13.3 million, plus depreciation and amortization, $3.7 million, minus capital expenditures, $6.6 million, yields 1973 owner earnings of $10.4 million. If we divide these earnings by the long-term U.S. government bond yield, 6.81%, the value of the Washington Post company reaches $150 million, almost twice the market value of the company but well short of Buffett's estimate. Buffett tells us that, over time, the capital expenditures of a newspaper will equal depreciation and amortization charges, and therefore net income should approximate owner earnings. Knowing this, we can simply divide net income by the risk-free rate and now reach a valuation of $196 million. If we stop here, the assumption is that the increase in owner earnings will equal the rise in inflation. But we know that newspapers have unusual pricing power, because most are monopolies in their community. They can raise their prices at rates higher than inflation. If we make one last assumption, the Washington Post has the ability to raise real prices by 3%, the value of the company is closer to $350 million. Buffett also knew that the company's 10% pre-tax margins were below its 15% historical average margins, and he knew that Katharine Graham was determined that the Post would once again achieve these margins. If pre-tax margins improved to 15%, the present value of the company would increase by $135 million, bringing the total intrinsic value to $485 million. Tenet, buy at attractive prices. Even the most conservative calculation of the company's value indicates that Buffett bought the Washington Post company for at least half its intrinsic value. He maintains that he bought the company at less than 1/4 of its value. Either way, he clearly bought the company at a significant discount to its present value. Buffett satisfied Ben Graham's premise that buying at a discount creates a margin of safety. Tenet, return on equity. When Buffett purchased the stock in the Washington Post, its return on equity was 15.7%. That was an average return for most newspapers and only slightly better than that of the Standard & Poor's, S&P 500 Industrials Index. But within 5 years, the Post's return on equity doubled. By then it was twice as high as the S&P Industrials and 50% higher than the average newspaper. Over the next 10 years, the Post maintained its supremacy, reaching a high of 36% return on equity in 1988. These above-average returns are more impressive when we observe that the company has, over time, purposely reduced its debt. In 1973, the ratio of long-term debt to shareholders' equity stood at 37%, the second highest ratio in the newspaper group. Astonishingly, by 1978 Katharine Graham had reduced the company's debt by 70%. In 1983, long-term debt to equity was 2.7%, one-tenth the newspaper group average, yet the Post generated a return on equity 10% higher than these companies. In 1986, after investing in the cellular telephone systems and purchasing Capital City's 53 cable systems, debt in the company was an uncharacteristic high of $336 million. Within a year, it was reduced to $155 million. By 1992, long-term debt was $51 million and the company's long-term debt to equity was 5.5% compared to the industry average of 42.7%. Tenet, profit margins. 6 months after the Washington Post company went public, Katharine Graham met with Wall Street security analysts. The first order of business, she told them, was to maximize profit for the company's existing operations. Profits continued to rise at the television stations and Newsweek, but profitability at the newspaper was leveling off. Much of the reason, said Mrs. Graham, was high production costs, namely wages. After the Post purchased the Times-Herald, profits had surged. Each time the unions struck the paper, 1949, 1958, 1966, 1968, 1969, management had opted to pay their demands rather than risk a shutdown of the paper. During this time, Washington, D.C., was still a 3-newspaper town. Throughout the 1950s and 1960s, increasing wage costs dampened profits. This problem, Mrs. Graham told the analysts, was going to be solved. As union contracts began to expire in the 1970s, Mrs. Graham enlisted labor negotiators who took a hard line with unions. In 1974, the company defeated a strike by the Newspaper Guild and, after lengthy negotiations, the printers settled on a new contract. Mrs. Graham's firm stance came to a head during the pressmen's strike in 1975. The strike was violent and bitter. The pressmen lost sympathy when they vandalized the press room before striking. Management worked the presses, members of the guild and the printers' union crossed the picket lines. After 4 months, Mrs. Graham announced that the paper was hiring non-union pressmen. The company had won. In the early 1970s, the financial press wrote that the best that could be said about the Washington Post company's performance was it rated a gentleman's C in profitability. 5 pre-tax margins in 1973 were 10.8%, well below the company's historical 15% margins earned in the 1960s. After successfully renegotiating the union contracts, the Post's fortunes improved. By 1988, pre-tax margin reached a high of 31.8%, which compared favorably to its newspaper's group average of 16.9% and the S&P Industrials average of 8.6%. Tenet, rationality. The Washington Post generated substantial cash flow for its owners. Because it generated more cash than it could reinvest in its primary businesses, management was confronted with 2 choices: return the money to shareholders and/or profitably invest the cash into new opportunities. It is Buffett's preference to have companies return excess earnings to shareholders. The Washington Post Company, while Katharine Graham was president, was the first newspaper in its industry to repurchase shares in large quantities. Between 1975 and 1991, the company bought an unbelievable 43% of its shares at an average price of $60 per share. A company could also choose to return money to shareholders by increasing the dividend. In 1990, confronted with substantial cash reserves, the Washington Post company voted to increase the annual dividend to shareholders from $1.84 to $4, a 117% increase. In the early 1990s, Buffett concluded that newspapers would remain above average businesses when compared to American industry in general, but they were destined to become less valuable than he or any other media analyst had predicted years earlier, principally because newspapers had lost their pricing flexibility. In previous years, when the economy slowed and advertisers cut spending, newspapers could maintain profitability by raising lineage rates. Today, newspapers are no longer monopolies. Advertisers have found cheaper ways to reach their customers: cable television, direct mail, newspaper inserts, and, most of all, the wide use of the internet have all taken advertising dollars away from newspapers. By 1991, Buffett was convinced that the change in profitability represented a long-term secular change as well as a temporary cyclical change. The fact is, he confessed, newspaper, television, and magazine properties have begun to resemble businesses more than franchises in their economic behavior. 6 cyclical changes hurt short-term earnings but do not reduce a company's intrinsic value. Secular changes reduce earnings and also reduce intrinsic value. However, the change in intrinsic value of the Washington Post company, Buffett said, was moderate compared to other media companies. The reasons were twofold. First, the Post's $50 million long-term debt was more than offset by its $400 million in cash holdings. The Washington Post is the only public newspaper that is essentially free of debt. As a result, Buffett said, the shrinkage in the value of their assets has not been accentuated by the effects of leverage. Tenet, the $1 premise. Buffett's goal is to select companies in which each dollar of retained earnings is translated into at least $1 of market value. This test can quickly identify companies whose managers, over time, have been able to optimally invest their company's capital. If retained earnings are invested in the company and produce above-average returns, the proof will be a proportionally greater rise in the company's market value.